In this video, we will be discussing which performance metrics are the most important for a trading strategy. Stick around to the end to receive a free expert advisor from us here at Prosperity Algo Solutions. So starting off with this slide, when we discuss performance metrics, which ones are really the most important if we look at a trading system or any sort of investment strategy in general? And in this presentation, we're going to discuss a few different options and look at the pros and cons of all of them. But to start off, I invite you to look at this little chart down here. We look at two different portfolios, Portfolio 1 in the blue and Portfolio 2 in the red. And as you can see, they both end up in the same place over a year, with having roughly the exact same return. However, Portfolio 1 was super choppy, oscillating up and down, whereas Portfolio 2 was very choppy, oscillating up and down, whereas Portfolio 1 was a nice smooth line, or relatively smooth line, going in a upward sloping direction. So if you were to just look at annual return specifically, these two portfolios would look effectively exactly the same. However, if you look at other performance metrics, the picture becomes very different. And that's why we want to discuss a few different metrics in this presentation and different things that you should keep in mind as a trader. So first of all, I wanted to kind of talk about an interesting phenomenon that I have observed being in the investment space for some years. And kind of an interesting comparison is that retail investors tend to think in terms of absolute returns, whereas institutional investors tend to think in terms of relative returns. And what do I mean by this? So if you were to ask a retail investor what the return is of whatever it is they're investing in, they'll probably just give you a return number like 10%, 12%, 13%, whereas institutional investors tend to focus enormously on risk-adjusted returns, including Sharpe ratios or Sortino ratios. And really the reason for this is institutional investors traditionally operate in a non-leverage constrained environment. If you are a hedge fund manager, for instance, your prime broker or whatever bank or broker you work with will offer you very, very significant leverage depending on what it is you're trading. Therefore, and what the logic would suggest here is as long as your cash flow is stable enough or your returns are stable enough, you can really lever it pretty enormously. And because of that, the limiting factor here is not necessarily just your absolute returns, but your returns over your drawdown and this general stability and risk related to your cash flow. And the perfect example here is, let's say you have a bond that yields 7%. And if you guys know bonds, you know that your cash flows are, depending on the type of bond, are effectively fixed. And you are going to get whatever the face value of the bond is back at the end of the bond's term. So let's say for illustration purposes, we have a 25-year term where you have a fixed cash flow for the entire period, and the bond is secured by a large G7 nation, so it's extremely low risk that the country would default on their payments. And here, if you, let's say, have a 7% yield on your bond, if you could borrow money at a 6% borrowing cost, effectively that 1% spread could be levered as much as humanly possible. So this happens sometimes in more of an institutional context where they have low borrowing costs and they're able to take on a bit more risk to get a higher bond yield. But this example kind of illustrates that really absolute returns don't really matter, because if you have a 200% return but you have a 100% drawdown, that's not nearly as attractive as having something which is just a small spread over a very stable cash flow so that you're able to apply leverage in a safe way. So just something to keep in mind as we kind of walk through the presentation. So the first metric that we typically look at is your compound annual growth rate. And effectively, this is just your annual rate of return taking into account compounding over the period. And if you're trading a strategy or a system where you're typically trading on as a percentage of balance, this would mirror the CAGR quite closely, because if your expert advisor, for instance, is constantly taking a 1% of balance trade, as your balance grows throughout the year, the trade size will grow as well. So this will inherently imply compounding. Therefore, the CAGR is, if you were to run a one-year MetaTrader backtest and it's based on balance, that most likely is the CAGR. And this is obviously very important because you want to make sure that you're having attractive returns throughout the year. So this is a very important metric to look at, but unfortunately it tends to not show you the entire picture. Another extremely important metric here is max drawdown. And a very famous quote is like number one rule of investing is don't lose money. And the main reason behind that, and we've all experienced this way too well if we as traders, like if you lose 50% of your account, you need to make 100% just to break even. And obviously, like you aim not to lose 50%, but the same math can be applied to a 20% drawdown or to a 30% drawdown. So as soon as your drawdowns get really, really hefty, you have to make a ton of money back just to be able to break even. And overly large drawdowns can ruin a great strategy. So even if you have a fantastic trading system or an EA or a bot, almost all of them have some degree of drawdown. And if you over leverage, that drawdown can bring your account to such a low level that you will need to make such enormous returns to actually make it back. And that's why like paying attention to your max drawdown is so important, because it can ruin a very good system. Not to mention it can mess with your trading psychology and whatnot. So proper risk management is really just so important. We can now look at a few other fairly common ratios when people evaluate investing systems or trading strategies in general. Sharpe ratio is probably one of the most popular, where you look at like the spread over the risk-free rate of return, which you can use a bond yield, for instance, like a government bond yield, and then you would divide that by the standard deviation of the portfolio. And the reason why I don't love the Sharpe ratio is that it also looks at like upside volatility. So let's say like you have very small drawdowns, but you have enormous spikes to the upside. Like Sharpe ratio would still penalize that. And obviously that makes no sense, because why would you penalize like good volatility as opposed to just bad volatility? And I've noticed as well that Sharpe ratio does tend to unfairly penalize scalping strategies when you have like long runs of winners followed by a bit of a sharp drawdown, like a bigger loss, which causes like a little dip in the equity curve. This does cause a decent degree of volatility in your equity curve, and the Sharpe ratio does penalize this pretty heavily, even if drawdowns might be modest. So that's why I find for trading systems in particular, it's a less important metric, but to each their own. We can now also look at units of R, and this is really popular in the whole like retail trading space, because people tend to use very high risk reward strategies. And what R implies is it just looks at return expressed in units of risk. So if you like risk 1 R to make 3 Rs, it means that your stop loss was set at 1 R and you in turn made 3 Rs when price hit your take profit. This is also a helpful metric because it can isolate for varying degrees of leverage. So you're able to effectively look at a strategy just in terms of units of risk and not in terms of absolute returns, where you may have only had a super high rate of return due to a high degree of leverage. So it is actually a very useful metric, but I find it tends to be used more in retail settings, just because retail traders use a lot of high risk reward trades, and that tends to be taught a lot, especially with the whole ICT concepts movement. But still a very useful metric to keep an eye on. My favorite metric now is return over max drawdown. And to the earlier point about institutional investors, is as CFD/Forex traders, we are also effectively operating in a non-leverage constrained environment. We can use essentially as much leverage as we want from our brokers, so it gives us tremendous advantages. However, like our returns are really limited by drawdown. If we could somehow find a trading strategy which was perfectly consistent with a 7% yield or even a 1% yield, but you could close it every day and you would not incur spread costs, we'd be able to just juice that to the max and make very large sums of cash. However, we are ultimately always limited by our max drawdown, because the more we increase our leverage, the more our drawdown will increase in a linear manner. Therefore, I find that if you look at the total return divided by the maximum drawdown, that gives you a really good indication of how strong the strategy really is, because you can, in theory, increase leverage up until your drawdown becomes something you're uncomfortable with. I'd still be careful with this, as backtesting is never 100% accurate, but this is really the metric which I would think that you should look at, because it shows you how much leverage can be applied in an intelligent manner. So, Hope you guys found this useful, and please stick around for the following short clip to receive a free EA from us here at Prosperity Algo. Take care. Before you click away, if you're looking to get a real expert advisor, here at Prosperity Algo Solutions, we're currently offering our Golden Time Bomb system based on automating the London breakout and opening range breakout 100% for free. Watch the pinned video to find out more and to get access.